Are you looking to build steady income and long-term wealth in Canada? You may want to consider investing in dividend ETFs. In this video, we will take a closer look at the best Canadian dividend ETFs, how they work, and which ones are worth considering for your portfolio. Dividend ETFs are exchange-traded funds that hold a basket of dividend-paying stocks. These ETFs are designed to provide regular income to investors while also offering the potential for capital appreciation. In Canada, dividend ETFs are especially attractive due to the favorable tax treatment of eligible dividends, making them an efficient tool for generating income. The main benefits of dividend ETFs include diversification, reduced risk, regular income, and cost effectiveness. By holding a wide range of dividend paying stocks, ETFs reduce your exposure to the risk of a single company underperforming. Most dividend ETFs pay distributions monthly or quarterly, which is ideal for income focused investors. Additionally, the management fees for ETFs are generally lower than mutual funds, making them a cost-effective choice. Now, let's explore some of the best Canadian dividend ETFs available to investors today. 1. Vanguard FTSE Canadian High Dividend Yield Index ETF, VDY. VDY is a popular choice among income investors in Canada. It seeks to track the performance of the FTSE Canada High Dividend Yield Index, which includes Canadian companies with above average dividend yields. This ETF has exposure to sectors like financials, energy, and telecommunications. With a management expense ratio, MAR, of 0.22%, it offers low-cost access to high-quality dividend stocks. VDY pays a monthly distribution and currently yields around 4 to 5% annually, making it a solid option for dividend-focused portfolios. 2. iShares SYNP TSX Canadian Dividend Aristocrats Index ETF CDZ. CDZ focuses on Canadian companies that have increased their dividends for at least 5 consecutive years. It tracks the S&P/TSX Canadian Dividend Aristocrats Index and includes a mix of sectors such as utilities, industrials, and consumer staples. The MR is about 0.66%, slightly higher than VDY, but the focus on dividend growth companies can appeal to long-term investors. CDZ provides monthly income and is a great choice for those seeking dividend growth and stability. 3. BMO Canadian Dividend ETF ZDV is another strong contender, designed to provide exposure to a diversified portfolio of Canadian dividend-paying stocks. It uses a rules-based methodology to select stocks with stable and sustainable dividends. ZDV's holdings are well spread across financials, utilities, energy, and industrials. The MER is 0.39%. And it offers a monthly distribution with a current yield close to 4.5%. This ETF strikes a balance between dividend income and diversification. iShares Canadian Select Dividend Index ETF XDV aims to replicate the performance of the Dow Jones Canada Select Dividend Index. It consists of 30 of the highest yielding dividend paying companies in Canada. The fund is heavily weighted towards the financial sector, which may increase risk, but also potential reward. With an MER of 0.55% and a monthly distribution, XDV is a viable option for investors seeking strong yields from established Canadian companies. When comparing these ETFs, it's important to consider several factors beyond yield. The sector exposure, fund size, liquidity, historical performance, and expense ratios should all be part of your evaluation process. For instance, VDY has a heavy concentration in financials and energy, which can be beneficial during bull markets but may increase volatility during downturns. CDZ, by focusing on dividend growth, provides a more balanced approach with exposure to a wider range of sectors. ZDV and XDV offer a compromise between high yield and diversification. HAL introduces active management, which can be a plus or minus depending on market conditions and management performance. How do you decide which ETF is right for you? It depends on your investment goals. If your goal is to generate consistent income with minimal fees, VDY is a great starting point. For those who value dividend growth and want a more diversified sector mix, CDZ may be a better fit. Investors who prefer a rules-based strategy with solid income might lean toward ZDV or XDV. And if you're willing to pay, tax efficiency is another reason why Canadian dividend ETFs make sense, particularly in non-registered accounts. Eligible dividends from Canadian corporations receive favorable tax treatment thanks to the dividend tax credit. In conclusion, dividend ETFs are a powerful tool for Canadian investors seeking regular income and long-term growth. Whether you're retired and need monthly cash flow or a younger investor building passive income, these ETFs can play a vital role in your financial strategy.